Good evening, everyone. Today, we are here to discuss an important change proposed under the Finance Bill 2024, which is with respect to the tax implications on buyback of shares. So, while it may seemingly look like the tax implications has been shifted to such that the tax burden has only shifted from the company's hands to the shareholders' hands, however, there's much more to it. And buybacks being fairly common amongst companies, and as you may see, the data in the data given by SEBI, which has also been published in various newspapers recently, shows that there has been an increasing trend towards buybacks. And in 2024 itself, in a span of only 6 to 7 months, we have seen around 21 offers of buybacks. So as we say this, the question here lies that why is buyback that significant? Why is it that companies do go for buyback? And while the data is there only for listed companies, we know that for unlisted companies also it is fairly common for companies to do buybacks. So, sir, can you please explain what are the motivations for companies to do buyback?
All right, let's get started first with why companies go for buybacks. And Payal, as you showed the data on the screen for listed companies, you're able to see 2023, there are 48 buybacks, adding to roughly about 48,000 crores, which is a substantial amount. Now, in case of unlisted companies as well, buybacks are fairly common, and buybacks happen for a variety of reasons. One reason, of course, is distribution of profits. Companies do buybacks to be able to distribute profits. Now, there are other ways for distributing profits too. For example, a company may simply distribute dividends. Dividends, however, have a different perspective, because dividends are seen from the perspective of consistency. Whenever any analyst, any prospective investors looks at dividend history of a company, he tries to see what's been the consistency of dividends. That would mean companies try to maintain a consistent history. Now, suddenly in a particular year, the company wants to, let's say, distribute quite a lot. The company would not create or would not like to create a history of excessive dividends in a particular year, because that becomes expectation of the shareholders in next year. So whenever companies want to do, let's say, major distribution in a particular year, instead of creating an outlier in the dividend history and creating excessive dividends, they probably go for a buyback to distribute part of the profits. So buybacks are done for distributing excess profits. That's part one. Part two, very importantly, buybacks are used for scaling down the company's operations. I'm sure this is very important for everyone to understand that unlike in case of partnerships and LLPs, where I can withdraw my capital, I can introduce capital and withdraw my capital. But in case of companies, capital is fixed. Capital cannot be reduced. Capital cannot be withdrawn. Because if companies want to reduce capital, there's a long process of reduction of capital under so-called Section 66, which has to go through shareholders approval, creditors approval, NCLT approval, and so on. So the only mode for companies to scale down their operations is to go for a buyback. And I'm sure people who are familiar with this law understand that buybacks can be done to the extent of 10% based on board resolution, to the extent of 25% of net worth bypassing a special resolution in a financial year. And therefore, progressively every year, if the company is wanting to scale down operations, it would probably do a 25% buyback in the month of March and do another 25% in the month of April, because that crosses the financial year. You can therefore successively scale down operations by doing a buyback. Now, no one can probably argue that once I create a company and introduce capital, I'll never need to reduce capital, because scaling down the capital base of the company might be strategically important for companies in many instances. The third significant reason, and this is very, very important, is to do a selective buyback from specific shareholders. Very often companies want to allow a specific shareholder an exit. Now, there's no specific, when I say specific shareholder, I mean specific shareholder or specific shareholders, or maybe a class of shareholders. It wants to allow exit to class of shareholders. Once again, everyone understands that when it's a redeemable preference shares, I can redeem preference shares. But there's no way to redeem equity shares. The only way equity shares can be redeemed is through buyback, because equity is by itself irredeemable. The only way to provide exit is to do a buyback. Selectively, therefore, certain shareholders who want to exit, the company may allow exit by offering them a buyback. In case of private equity transactions, strategic investors or venture capitalists, it's a very common stipulation in shareholders' agreements to say that the company writes a put option. The company writes a put option, meaning the shareholder may, at certain time or based on certain conditions, put the shares back on the company. When the shares are put back, meaning sold back to the company once again, the only way the company can buy the shares back is through the buyback window. Next, we also understand that in case of CCPs, compulsorily convertible preference shares, and compulsorily convertible debentures, given the fact that the instrument is compulsorily convertible. Here again, the only way to permit a shareholder an exit is through buyback window. And I would also say that in case of ESOPs which are vested but not yet exercised, remember that ESOPs, if they've been exercised, that would mean the shareholder, the ESOP holder now has shares. And in that case, of course, the shares can be bought back. But prior to exercise, that would mean vested options which have not yet been exercised, it may be possible for a company to offer a buyback, because that's also one potential window for a company to buy back. And there one might probably see some degree of tax arbitrage there, because once the ESOPs get exercised, the perquisite becomes taxable. But prior to exercise, if ESOPs can be bought back, there might be different interpretation on what's the potential taxability of buyback of ESOPs. So I indicated various reasons why unlisted companies might have to do it's not a tax arbitrage issue, it's not a tax planning issue. Buyback is a sheer financial planning, capital planning for companies. Companies strategically plan buyback to manage their capital base, and buybacks are fairly common in case of listed as well as unlisted companies. Quickly to summarize, unlisted companies may do buyback: A, for the purpose of distribution; B, for the purpose of scaling down; C, for the purpose of offering a selective buyback; B or D, by way of a put option to strategic investors; E, for the purpose of buying back CCDs or CCPS; and F, for the purpose of buying back vested but not exercised ESOPs. So there might be a variety of reasons. Payal, over to you.
Yes. So we understand that there are a variety of reasons why a company would go for buyback. Now, talking about the present proposal, how does the budget provision for buyback hurt the buyback? It was explained as something that brings equity to the tax on buyback. So if the intent was to bring equity, why at all this opposition?
Right. This was explained as something which is intended to offer equity, because Payal, you might understand that this is coming from a SEBI consultation paper by a working group headed by Mr. KK Mistry. And this consultation paper had recommended that present structure of buybacks under section 115 QA is little inequitable. What's the inherent inequity there? Because as I'm sure everyone understands, the present provision of 115 QA says what? That when the company does a buyback, to the extent the company is buying back a share at a price which is higher than the issue price. Let's assume some quick numbers there. Supposing the company had issued a share with a par value of rupees 10 at issue price of rupees 50, and the share is now bought back by the company at a price of 80. So the company's issue price was 50 rupees and the buyback price is 80 rupees. Therefore, the company is returning excess of rupees 30 because it's buying back at 80. To the extent the company is returning more value than what it got, it's therefore distributing profits, and this distribution will be taxable in the hands of the company. Now, the inequity there was that the company pays tax. Given the fact that the company is paying tax, the tax is paid for the outgoing shareholders, because the money is going to shareholders who are exiting the company. Therefore, the profit is back, the profit is reaped by shareholders who are going out, but the tax is paid by shareholders who stay back in the company. The tax is on the company, and therefore the tax hurts the remaining shareholders, whereas the money is picked up by the outgoing shareholders. So the KK Mystery working group had suggested that there is inequity there, and therefore the tax base may be shifted to the outgoing shareholders instead of the incoming or the staying back shareholders. This was the recommendation of SEBI, but while the recommendation of SEBI was to bring equity, what the finance minister actually has done is to bring fatality to the entire provision. Fatality in the sense that if this provision stays the way it is, and the finance minister is not compelled or not inspired to buy back or roll back the provision will actually say bye bye to buybacks, because the way it stays, it actually says that the entire money. I took an example of, let's say, the company paying 80 rupees against an issue price of 50 rupees. Now, what the provision effectively says is that if the company is paying rupees 80 against a share which was issued for rupees 50, the entire 80 rupees will become taxable in the hands of the shareholder. Therefore, the shareholder will pay tax on the entire 80 rupees. Now, given the fact that the shareholder had actually paid 50, he's paying tax on 80. So the finance minister says, fair up, don't worry. This 50 rupees that you lost in the process, because you actually paid tax on entire 80, which includes your own capital of rupees 52. Don't worry, I'll give you relief, because now this 50 rupees that you suffered, I'll allow you to claim this as a capital loss. Now imagine the underlying, counterintuitive argument there. This is almost like saying that I'll come and grab your property, take your property away in form of taxes, but don't worry, you can still claim your property lost by way of a capital loss. So I'll cause a capital loss to you, I'll take away your capital and give you a capital loss, and then you can claim the capital loss against your capital gains. Quite an absurdity, say, on constitutional provisions itself, because after all, income tax can be imposed on income. If the company paid rupees 80, which included 50 rupees contributed by the shareholder himself, there's no stretch of argument to say that the entire 80 rupees is income. And therefore, on the fundamental principle that no one can tax what is my own capital in the guise of taxing income, my own capital cannot be taxed. On that very ground, probably this provision will have to be reconsidered, or will probably have to be taken to courts, and probably the justice may be restored by courts. But the way it stands, it will completely undo any kind of equity, which is the bare minimal, fiscal equity expected in taxation laws. For example, Payal, as you probably show in your example as well, if the share is bought back at 80 rupees, the shareholder is making a gain of 30. However, is paying tax on entire 80. Take another example. Supposing the company buys back a share which was issued at a price of 50 rupees at rupees 50 itself, which means the shareholder paid 50 rupees, is getting back 50. In that case, too, the finance minister says, I'll tax you entire 50, and then I'll allow you to claim the capital loss of 50 rupees. Even a worse situation, supposing a company issued shares for 50 rupees and the company buys it back for a price of 40. Therefore, the shareholder is actually getting a loss. But the FM comes and says that I'll tax you on the entire income of 40, and then allow you to claim the 50 rupees paid by you as a capital loss. So there is a complete inherent inequity in the entire provision, and therefore the way the provision stands, it introduces a complete lopsided view where the entire capital contributed by the shareholder is also taken as income. This has never been so in taxation history. Therefore, this is a completely. I'm sure something must have gone wrong. Something might have gone wrong in briefing. Something might have gone wrong in conceptualization. Something somewhere is amiss, because the way it stands, it's very difficult to absorb or understand this file.
So, sir, in case of loss, where buyback results into a loss in the hands of shareholders, why would shareholders actually tender their shares for buyback?
Good question. Why should a shareholder go for a buyback if the company is paying 40 for a share which is issued at price of 50 rupees? That's a directional call. As a shareholder, I'm trying to take a call on whether I should stay back in the company, suffer further losses, or exit. If I apprehend that if I stay back in the company might lose further value, and today the company is paying me 40 rupees, tomorrow I might sell the share at 30 rupees. Illiquid shares, loss-making companies, difficulties of exit. Therefore, that's a call of the shareholder. Shareholders actually do take a call. It's not that shareholders don't sell shares at a loss. So I can sell shares at a loss and try to cut my losses, limit my losses by selling shares in the secondary market. Likewise, I take the decision of offering shares in a buyback. Buyback is nothing different from offering a secondary market through the company itself. Shareholders is getting an exit window through the company, particularly valid in case of unlisted companies or private companies where a market does not exist.
So here we can also discuss briefly the tax
the tax implications on buyback prior to this proposed amendment?
Absolutely. And prior to the amendment, the tax provisions were quite simple. Like I said, 115 QA said the tax will be paid by the company on the excess of buyback price over the issue proceeds. 115 QA said the tax would be paid by the company. There was a carve out for the shareholder, irrespective of whether the shareholder was getting a gain or getting a loss. Section 1034A, I guess, allowed the shareholder that the shareholder will not be called upon to pay tax on the amount paid by the company. So it was exempt completely in the hands of shareholder, taxable in the hands of the company at a rate which effectively, including surcharges and educational cesses, etc., would amount to something like 23.4%. Now, the question here, and Pal, that's a valid question once again, is to ask if the company was paying a tax of as much as 23.4 on the excess value. Was there any kind of a foul play? Was the FM trying to attack some kind of avoidance gimmick, some kind of avoidance device, some kind of tax arbitrage? Was there some kind of a foul play involved here, which the finance minister is trying to attack by shifting and making the entire buyback price taxable? I cannot think of a foul play here because 23% upwards of 23% rate of tax on dividends on the profit distributed. Now, looking at the average tax rate of shareholders, looking at shareholders, variety of shareholders, some probably might not have taxable income at all. Some might probably be taxable at, let's say in alternative regime, they are taxable at a lower tax rate. The average tax rate for shareholders in general couldn't be amounting to more than 23%. When the company is paying tax at 23 something, that by and large measures with the average tax rate for shareholders too. So shifting the burden from companies to shareholders, or shifting the burden from shareholders to companies, there wasn't any scope for a revenue leakage. Therefore, this is not an anti-avoidance. Normally, when the stance is anti-avoidance, but probably well, there was some revenue leakage happening, there was some avoidance gimmick, there was some tax planning involved, and we're trying to curb a tax avoidance device. Looking at the rate, I cannot think of a tax avoidance. There were some schemes of arrangement, particularly those which had issued bonus preference shares, which probably might have tried to take advantage of the provision to introduce preference shares instead of dividends. And maybe the preference shares might either go for redemption or might go for a buyback. Probably there might be some certain large companies trying to create some opportunity, but by and large, the entire activity of buybacks was more a kind of financial planning, capital planning, distribution planning, scaling of capital for companies rather than any kind of a tax arbitrage. So it's difficult to contend that there was any kind of a foul play involved in buybacks file.
So talking about redemption of preference shares, as you just mentioned, does the scope of the new provision also extend to the redemption of pref shares?
No, I wouldn't say this provision at all extends to redemption of preferences. There was earlier a doubt being expressed by people about redemption of preferences too, and the basis for the doubt was that the language of 115 QA earlier referred to, it said buyback under any provision of law. It was referring to any provision of law. Of course, now the language is specifically referring to section 68. Preference shares are not bought back. Preference shares are redeemed. Redemption meaning there was a time for redemption. Preference shares had a limited life. End of the life, the preference shares are bought back. They're simply redeemed because redemption of a fixed maturity instrument cannot be said to be buyback. Buybacks would particularly be pertinent, say in case of equities, which doesn't have any redemption timeline at all. So redemption of preference shares, to my mind, cannot be a case of buyback. In case of, let's say, preference shares which were callable, let's say redemption was end of 10 years, but the company could have redeemed preference shares earlier than 10 years, that also would be a case of redemption and not a case of buyback. Buyback would mean the instrument did not have a maturity at all, and the instrument is cancelled by the company buying it back. Fine.
In that case, can we say that the provisions of the scope of this provisions extends to the redemption of CCDs being compulsorily convertible debentures?
Once again, not, because the provision is very clearly, when I'm talking about the provision, I'm referring to the proposed insertion of clause F to section 2/22. 222F refers to buyback of shares. It talks about shares. So number one, even if the provision remains enacted, the way it is drafted currently, it would be applicable to buyback of shares. It wouldn't be applicable to buyback of CCDs. So if at all a company is buying back compulsorily convertible debentures, it's not a case which is to be covered under section 222F. If the company had issued compulsorily convertible preference shares, look at the jargon itself, it's compulsorily convertible, meaning it's not redeemable at all. And there is no option but to buy it back. And there, of course, we are buying back a share, and therefore the matter may be covered by section 222F. But CCD, answer would be no.
Okay. So, sir, the proposed provisions require buyback to be taxed as dividends. There's an insertion of subclause F under section 222. Now, if we see the construct of section 222, it relates to distribution. So, is it possible to argue that as the rest of the section 222 relates to distribution, the subclause F will also be limited to distribution, and therefore only the profit distributed by the company will be taxable?
I would really be very, very happy if this was the interpretation. But Payal, as you are aware, the finance bill itself gave an example in the memo of clauses to the finance bill. There is an example given by the government itself. And the example itself makes it clear if the company is distributing 80 rupees, the entire 80 will be taxed, irrespective of how much is the excess or how much is the distribution made by the company. So much so, ironically, that even if the company does not have any profits, question of dividend or deemed dividend comes when the company is distributing profits. What does dividend mean after all? Section 222 talks about dividends, and A to E talk about deemed dividends, meaning what? The company in the following circumstances will be deeming to be distributing profits. Distribution of profits presupposes a profit. If you talk about a company which does not have profits and is buying back shares, let's say without having profits, because buyback can be done out of premium also. So much so under section 68, buyback can be done out of fresh issue of shares as well. This is a very important point to understand, that for buyback, we don't need profits. Section 68 permits the company to do a buyback out of profits, out of share premium, also by issuing fresh shares. So I can do a buyback by issuing fresh shares. Therefore, the company doesn't need profits. And if the company does not have profits, the question of the company distributing or dividing any profits, therefore dividend, the question of dividend does not arise. However, the way section 222F is now proposed, presented, the way it stands, the way it currently is, it's unrelated to the extent of profits, and the entire amount paid by the payment made by the company is intended to be tax filed.
Sir, considering the impracticability of the proposed provision, are you hoping that this provision will be rolled back or at least modified before the final notification?
I'm very, very optimistic on this. I don't think I need to be extremely optimistic person, or extremely, let's say, so impractically optimistic person to rely, but the way it stands, and I think anyone with any sensibility, if it's proposed, presented, the facts are properly presented to anyone, the provision as it stands is completely impractical, and therefore there would probably be a review. The only debacle there is that quite often when lawmakers take 2 steps forward, they probably take 1 step backwards. So they probably leave some inequity, try to address some. For example, the same thing with the so-called angel tax. Angel tax was introduced with one particular perspective, was introduced with completely different perspective. Remember, section 56 to 7B was introduced to arrest black money. It later on was mostly affecting startups which did not have any black money at all, hardly a question of black money. However, it continued to hurt startups, and the year after year, the finance minister gave some carve out, some windows, some relief to startups. Eventually, they realized that this section is completely odd currently, and therefore had to completely scrap it. So the debacle I feel is that while there would still be some kind of corrective measures to address the inequity, which is very inherent in section 222F, but the problem with any policy maker is that once a policy maker makes a mistake, a policy maker's mistake becomes his philosophy. It finds any region, any sophistry, any kind of philosophy to say why my mistake was justified. That's the biggest issue. So I am hoping that the draftsmen do not use their sophistry, do not use their technicalities to try and find some justice in something is actually a bad construct. As simple as that, it's a bad construct. So I'm hoping we learn to call a spade and realize that we made a mistake and therefore roll it completely. I mean, you can shift the burden to shareholder, but tax him on his income, not on his capital. Nothing wrong in taxing the shareholder on his income. Tax him on his income. Tax him on the excess of the buyback price over the price paid by the shareholder over his cost of acquisition. Tax him on that, but don't tax him on the entire payment made by the company. But that is height of inequity. So I am hoping that there will be some corrective measure, but I'm only hoping that it doesn't lead to some inequity still remaining on account of people justifying what they've done.
In that case, sir, assuming that the provision stays the way it is, how will companies now distribute profits? And secondly, if at all they need to, how will they scale down their operations? Is there any alternative to make a selective reduction of capital?
So two things. First of all, the provision is getting effective from 1st October 2024. Currently, we're standing by end of July, so we still have 2 months. And Payal, I'm sure you can say that within 2 months, we still have 2 months to go. Effective date is 1st October, which actually would mean the payment must go to the shareholder before 1st of October. And Payal, you tell me, and you tell our visitors as well, whether it's possible for unlisted company, A, B, is it possible for a listed company to complete a buyback within 2 months? Unlisted company, I think, is easy. Because all you need to do is to pass a special resolution. Passing a special resolution for unlisted companies, you could probably do a meeting at a short notice. Assuming you have the right cooperation from shareholders, I'm sure you will probably have, because after all, you're doing it for shareholders' benefit. So do a short notice meeting, pass a resolution. Even if you do a regular meeting, you still have 25 days time to call a meeting and do a buyback. And once you get a resolution passed, thereafter it's a matter of simply making the requisite payment and tendering the shares, paying for the shares tendered. That's I would imagine that if you pass special resolution and then circulate a buyback offer and allow some time for the buyback offer to be taken by the shareholders, it would still be possible to complete the entire process in case of unlisted companies within 60 days. Payal, am I okay on that?
Yes, sir. Because when talking about buyback offers, especially in case of an unlisted company, even though an approval of shareholders may be required, suppose that there's a buyback offer period, which is generally spanning between 15 to 30 days. But companies do have an option to take the consent of shareholders and keep the buyback offer period short. So, especially in case of a closely held company, it will be very easy for them to, open a buyback offer, close it in a matter of 3 to 7 days, and the entire buyback process can be very easily completed within a period of, if not 15 to 20 days, in case shareholders approval is required, at least within a period of 1 to 2 months easily.
If I play by the timeline if I play with the full timelines as expected, even then I'll be able to finish it by 60 days. Because even if I offer 15 days minimum offer period and I take 25 days to call the meeting and then I have money ready to pay them, I must have liquidity, of course. I must plan it soon enough. I must have liquidity. I must do the requisite arrangements. I'll still be able to pay the money, make sure the money reaches the bank accounts of our shareholders within 60 days, right? In case of unlisted companies. Now think in case of listed companies, will it still be possible to finish it within 60 days? Or is it tough?
In case of listed companies too, while there would be a shareholders approval, which will mostly be requiring postal ballot, and postal ballot in itself will require 30 days, still completing the entire process by 60 days, the 2 months timeline, seems to be feasible and possible for the listed companies as well.
I mean, the going is tight, but I can still accomplish. Looking at the implications of what would happen from 1st October, I mean, when I have a deadline and beyond the line I'm dead, the deadline is so severe that I'm dead beyond the line, then I think everyone would try and reach there by the 30th September. So it's possible for companies to accomplish a buyback by September 30th. Assuming that we are into the new era and that the provision is not amended at all, it becomes applicable the way it is. In that case, well, I'll only have two options. A, for distribution of profits, I'll choose the dividend route. Dividends can be declared out of current year's profits. Dividends can be paid out of past year's profit. Dividends can be paid out of dividends can be paid by way of interim dividends. Dividends can be paid as final dividends. So whatever is my distributable profits of past year, past years, or the current quarter of the running year, I can distribute dividends to the extent permissible under the law by way of final or interim dividend. That's part one. Part two, if I actually want to scale down my capital, if I really want to scale down and pay back my capital, then as per the existing law, the only process would be to go for reduction of capital in terms of section 66. Reduction of capital requires tardy process. I have to go for special resolution of shareholders. I have to call a meeting of creditors of every class, pass a resolution with requisite majority in a class meeting, then make an application to NCLT. The NCLT will have to approve. The entire process may take, to my mind, nothing less than 6 months. In case of listed companies, it might even be longer because this might also have to go for stock exchange NOCs. So the process may be quite elongated, but that would be unfortunately the only way for companies to scale down, unless companies now start thinking in terms of using CCDs, because CCD, remember, is still out of the scope of section of the proposed clause F of section 2/22. File.
All right, sir. We thank you for the inputs that you have given. We do have live audience here, and in case live audience has any queries, they would want to put it over chats, or if they would want to unmute themselves and ask the queries, we can take a few queries there.
I guess people may not have questions, Payal. So we hope that we don't have to say bye-bye to buybacks. And we hope that there will be some correction, some corrective measure to address the anomaly inherent in this provision. Keeping this wishful optimism, I think that's where we say bye to all our visitors, all our spectators. And I hope we don't need to say bye-bye to the buybacks. Payal, thanks, and thanks everyone.
Thank you.